Europe continues to take centre stage. We've had interesting sets of data out on Friday morning. It relates to the Purchasing Managers Index, and this is survey based, and that has taken a look at the confidence of purchasing managers in Spain, Italy, France and Germany. And it's interesting to note that all four numbers came in well below expectations. Most of the numbers, apart from Germany, are in the 40s and low 40s. A number of below 50 represents contraction within economies. And I think this is the key talking point at the moment, where the G20 ministers meet for their meeting. Greece continues to dominate the agenda there. That act of unity in Europe was blown apart by the calling of a referendum in Greece, and has really turned the whole situation on its head. But assuming that that does get resolved and that we can get back to some unity within Europe at the moment, I think the next topic of conversation is, well, what is going on with the economy? Because, again, to make the point, European leaders have proved amply that they've been falling one step behind what is going on in the economy, and these contraction numbers today, I think, are indicative of greatly slowing economies in Europe at the moment, and some of these bailout numbers may be mispriced. In all of that is had a negative impact on the euro. We turn to the chart here of the euro dollar, and this rise here was on the back of the approval of the bailout for last week, and this sell-off has been the upheaval in Greece for this week. So a resumption to the downside there. In terms of the chart that I think will be a constant feature, last week we mentioned the Italian bond as being one to watch and to keep high up on the watch list, and this was in light of the bailout. Well, this week we can see that the yield on Italian bonds did continue to rise. There is only one buyer in town for Italian bonds at the moment, and that is the ECB, purchasing quantities of bonds there to try and suppress the yields, because as next year, of their 1.8 trillion euros of debt, there are, we think, around 300 billion euros of refinancing requirements. And of course, if this has to be done at 6.5%, then clearly this is a number that will prove unsustainable for Italy in the long run. Let's bring it back to home. Let's start to look at some equities, and I think just some interesting trends that I'm hearing on the high street. We're seeing a very mixed picture on the high street at the moment on retail sales. I've heard some retailers comment that there was a 3-week period in September where sales fell by significant amounts. We're talking 10, 20, even 30%. Now, this was a short period of time, maybe aided by the seasonally warm weather, but certainly confidence is very poor on the high street. But there are always shining lights, and I will highlight Next here. Next delivered good numbers this week, and this share price now is at an all-time high, very rare in the retail space. It's fair to say that the retail side didn't necessarily, it's not doing particularly well on the high street. It's doing well, but it was cool. The catch-up here was the directory, which had a good period. I want to contrast this chart with the chart of Mothercare. This is the chart over the course of this year, and just highlight the fact that it's now lost 75% of its equity over the period of this year. So a dramatic fall from grace for Mothercare, and really struggling. But I could put up charts for Home Retail, which owns Argos, and other retail organisations that are increasingly becoming challenged by the technology revolution that's taking place in the retail space. Next, as I say, with its directory, is keeping pace. In terms of other companies that are beginning to warm, Smith and Nephew in the healthcare space, just releasing third quarter numbers, which have proved to be disappointing. The shares are responding. Don't forget that this was a company that earlier this year had bid speculation, which caused the shares to spike up at this level to £7.50. Just a question mark. If anyone were to move on Smith & Nephew, timing could be quite good now. So, as I say, we'll keep an eye on that one for speculative interest at this stage. The other big feature of this week has been about counterparty risk. This is stories that sit within the city, but the demise of MF Global has really got everyone questioning once again who they are trading with, where they have their money, and looking at everyone's exposure. One American bank that came under some pressure we saw yesterday was Jefferies, the investment bank. Saw a big fall in its shares and having to respond to market rumours that they have European exposure to the bonds. They clarified that, which I think gave some comfort to the market. But as I say, everyone is looking for counterparty risk. Another share here that is coming under some pressure is ICAP. ICAP does trillions of dollars of businesses in a range of financial instruments with other companies, mostly on exchange, so shouldn't have necessarily a counterparty risk. But nevertheless, this whole thing is weighing on the financial sector at the moment, so it's moving from banking to investment into investment banking. And finally, just a picture on Lloyds TSB. We saw here that their new chief executive, who's done a good job in the early months in bringing some investor confidence to his turnaround plan, had to resign for extreme fatigue. He won't be in contact with the bank for at least 6 to 8 weeks. Some are talking that he won't be able to come back. That's leaving Lloyds rather open at the top in terms of management.